Hi there, welcome to another session for Freelance Business Week. I'm Joniette O'Neill, co-organizer for Miami, and I hope that you're enjoying all the content that we have prepared for you. Oops, there's a problem with my audio here. Sorry about that. Oops, something else started playing. Okay, so we're good now. Sorry about that. I hope that you're enjoying all the content that we have prepared for you. In this session, we're going to be learning from Aaron Chavez. His superpower is a strategic business analysis, and he'll be sharing all about financial projections so we can grow our businesses. So I'll bring Aaron to the stream. Hi, Aaron.
Hello. Happy to be here.
Yeah, the space is all yours. Thank you for your time. Really excited for this session. So let me add your presentation here.
Sounds good.
We can get started.
I love it. Let's get right into it. So, hello everybody. Happy to be here. Really here to focus on, talking about you're a freelancer and you want to plan and you want to understand what projections mean, what pricing means, and how you can build a business instead of just operating within one, right? Because unfortunately, is the business running you or are you running your business? That's kind of the big question that a lot of freelancers and independent people have to face at one time or another, especially as you look towards the future of what you want to be as a freelancer, whether it's expanding your freelancer base, changing your life in terms of what you want to do and how you want to operate within the freelancer space. There's a whole myriad of questions. So definitely good to consider all of these things and figure out what your plan is going forward. So a little bit about myself and my team, so you know who's talking to you and where we come from. My name's Aaron Chavez. I'm originally from Arizona. My background is investment banking. I moved to New York straight out of college, did investment banking for a number of years, did a lot of capital raising, did a lot of advisory, really got to see what the inside of successful businesses and growing businesses need from the high level and from, the nitty gritty of analyzing them, all the way down to the last penny. My team echoes a similar background, private equity experience, investment banking experience, master's in finance. So very focused on understanding the strategic impacts of financial decisions, right? Every decision you make is financial at the end of the day because, of course, it has those impacts. So what are you going to do to actually live up to them, plan for them, and use them to move you forward versus just letting you, continue to exist, right? So we're here and we work with people very much to kind of help them plan, help them strategize, help them think through all the good and bad scenarios that are happening so that way they can get more invested, more involved, and continue to, execute on their vision. A very high level of what we're going to talk about today. So one, we're going to talk about just setting the stage from a high level on financial models. Where do they sit? What's their utility? What does it actually mean? We'll talk about the types of models because, of course, there's not one type of cake. There's not one type of model. You have to figure out what you need and both the depth, the focus, the flows, whatever it might be that suits your situation the best. We have use cases because, of course, different businesses, different freelancers, different needs are all going to have certain implications, right? And we want to make sure that we make it the easiest possible for you to understand where you need to be, what you need to do to fulfill that, and how you can plan for when you're going to need this model, right? Because you don't want to build one thing one time and then have to tweak it 80 times before you get to the next thing. You kind of want to know the tempo that you're going for in a big way. We'll talk about some of the core tabs and best practices when actually building your model, because, of course, building it is, half the fun. Key metrics, we'll talk about some of the areas that are especially important to touch on, especially as an early stage freelancer, because what you're trying to do is understand not only how are you going to plan your business, but how are you going to hold yourself accountable? So you're not a startup, you're not a small business, in this example, you're somebody that reports to themselves, right? Well, what are your goals? What's your ambition? If freelance is for fun, then, it's one of those things. If it's supplemental and useful for networking and meeting certain needs like that, then that's one way to approach it. And the revenue, the key metrics, they become a little bit less relevant as long as you're moving the path forward in the way that you're quantifying your success, right? But if you're looking to grow, if you're looking to engage, if you're looking to build, your freelance position, whether it's bigger clients, better clients, more of them, less of them with higher ticket values, whatever it is, there are certain metrics that you're going to want to look at, prioritize, and ask yourself about so that you can set yourself up for the best odds of success, right? Your business model. So of course, there's 100 ways to do everything in this world. So freelance is no exception. So how you price, who you price, when you price, the geographies that you price, how your pricing is different or differentiates. Whether you're taking some cash, some is you front load, some you back load, some you take equity in a company that helps you, right? If you want to play that game as well. So a lot to consider in terms of how you're going to make money. Last, we'll talk about the financial model in terms of what that fully entails, and then I'll of course put my info up. Feel free to reach out and ask any questions. Happy to help where I can. So first things first, setting the stage on financial model. So I'm sure you've seen this page. If you haven't, I definitely recommend it. The business model canvas. There's 100 videos out there with 100 people that sound similar to me, but are probably a little less wordy, that can explain the ins and outs of what this full system means. But the high level is these are the basic building blocks of every given business. Some have more, some are less dependent on these different areas, but these are kind of your big building blocks. In the dead center, you have your value proposition, which of course sets up what value you're bringing to whom, which leads to what. So we're a software company that helps pizza shops in the Southeast make more pizzas in less time, right? We automate some back end systems and make them 20% faster. Like, boom, I'm providing this value. So if you're a freelancer, it could be I'm providing oil and gas companies with the best written business plans to get funding for short-term capital need for the bank. That could be an option as well. It's really understanding kind of your flow of what you do for whom and what outcome, what value, what quantifiable thing can you show that it leads to. And we'll talk more about this as we look towards the financials, but conceptually, that's where you're that's your building block, right? That's your pillar, that's your main support beam, and everything else kind of similar to the graphic, but it builds out from there, right? On the right-hand side, you have the customers and the individuals that you serve there. And again, there are questions here. What do they cost? How much does it cost to get them? What are their impacts? How much money are you making? The customer relationship. Having a very high-touch relationship where you're calling them like a concierge every single day is very different than a once-a-month check-in with you sending them their basic social media posts and moving on their way, right? And both have different costs because your time is what you're spending for this work, right? So your cost is time. So the more time you take out of every client, or the more you involved time you put for every client, the time that gives you a headache because you're working real hard, like those are different hours and those have different values and those have a price and a cost, right? So understanding the nature of the types of customers that you have, the way that you deliver service, the methods for actually getting to them and finding them, whether it's random, whether it's support groups, whether it's Facebook, LinkedIn, people in the real world, friends and family. It's a question of what does sourcing look like, right? Because a great customer could be great, but if you can't get to them, or you don't know how to source them, or it costs $300,000 to run all the advertising you would need to get them, are they really your best customer, right? Who is accessible? Who can you base a business off of? Who can you look towards and plan towards for a bigger future and the goals that you've set for yourself, whatever they may be? On the left-hand side, you look more into the internal side of the business. So who are the key people we work with? It could be the back-end people that do our bookkeeping and accounting. It could be people that we refer to on a heavy basis. Or for example, I do a lot of financial strategy, right? I am not a bookkeeper, but we've worked and we found a bookkeeping partner that we feel very strongly about that does great work and does our work for us. So we have a dedicated partner in there where if I was filling out this for our business, that bookkeeping company and that back end financial company would absolutely be in our key partners because they're a critical part of how we engage with many of our clients, right? They're just not work that we in particular choose to focus on. Key activities are the activities of the business and how you actually deliver your value, and the resources are what you use to get there. Now, our focus, and I say all that at the top just so you can kind of get a snapshot of where we're kind of what's the playing field look like and how can we carry that forward. So what our focus today is going to be on the bottom part, which is similar to a house, it's the foundation, which is how much does it cost and how much can you make, because you're spending money to make money, right? You're investing, you're spending time, you're doing marketing, you're being out there in the world, you're networking, whatever it might be, to make money. So understanding how much can you afford to spend, and then what are you actually aiming to make, and how can you optimize that, right? Because a big focus that I think it's important, and if anybody here is a fan of old literature, it's East of Eden. It's now that you don't have to be perfect, you can be good. And I think that's really kind of the way that freelancers should approach it, because you're operating on your own, more than likely. You're operating with limited kind of back end support. You're going to make some mistakes. The goal is not to be perfect. The goal is to improve. The goal is to be better. So to that end, it's better in all areas. It's refining your value prop. It's making your key partners more known and more credible and more qualified. It's improving your customer segment. And a big part of it is improving your cost basis, which means reducing the cost, of the company as much as you reasonably can, right? We know that companies, we don't want to run sweatshops, right? Both for you or anybody that you employ. But we want to make sure that where we can afford to not just waste money and burn cash, that we put it towards people, that we put it towards investment, that we put it towards growth initiatives that actually yield something versus just spend money out the door day by day, right? And on the revenue side, it's a question of where does your skill and time and revenue all come to be? So what I mean by that is, more often than not, these decisions that you're going to be making, they're not binary. You're not going left or right. It's a vector. And what does that mean? It means that you're taking the best case. So we have a certain amount of time, because you can't do every 100-hour-a-week job, right? From just a baseline time perspective. So you have a certain amount of time. You have a certain amount of knowledge, because you might be very specialized in one area of consumer retail, but maybe not in another. And it's going to take 10 times the work and a bunch of independent research and all this stuff to even deliver half the value that you could provide if you just focused in the sector that you knew. And then, of course, what's the client willing to pay? If the client's, has super deep pockets, maybe it's worth investing a little bit more, doing a bit more work, getting outside your comfort zone, depending on, again, what you know and what your goals are, and what does that look like. Now, if you don't have all that time, if you don't have...
Sorry to interrupt. We had someone saying that it's hard to read this. Can you go full screen with the presentation so they can see the details with this?
Let me see. I wonder if there's full screen. Here, let me actually load the PowerPoint, because that I know I can do full screen, and then I'll just reshare that.
Okay.
Perfect. Let me know if you can see it and if that looks more clear.
Yes. Is
that good?
Yes. Thank you.
Perfect. So here it's, again, looking at, in that vector, right? Can they afford to pay you? And is it worth making that time and resource investment? How are you going to optimize versus your goals, right? Again, the goal isn't just make money and get the biggest clients and do whatever. It's, what do you aim? What do you want? Whether it's more money, more prestige, more industry access, whatever it is, and how can you align your incentives to get you that way? So types of models. So models, as you can imagine, some of them are situational. If you're being bought and sold, if you're selling a company, if you're selling certain services, if you're selling your team, teams can be purchased as well. That requires different math and different financials than if you're just trying to operate, if you're trying to project, if you're trying to, get a sense of where you are. So on the left-hand side, you've got more of what we call a full operating model, which is kind of a little bit of everything. So you've got your projections, what your go forward is. You have your budget, so you know what your plan is for expenditures. You have your income statement, which shows your profit and your loss. Your balance sheet, which speaks to all the assets, the liabilities, and the equity. You've got your cash flow statement, which shows you can make a bunch of money on January 1st, but if you have a 12-month contract, right? If you have $12,000 contract for the next 12 months, then at the end of January, you've only made $1,000, right? Because it's 12 months of service. So you're earning that income over time. So you might be on January in the income statement, you might be super rich. But on the cash flow statement, if you're only earning that money every month, really you should only be spending that money that you're earning and thinking about spending that, because that's what you've actually earned for value. So that is a very different January looking at the income statement versus looking at the cash flow statement. And do we appreciate the difference, right? Because if you get 3 months into that contract and there's a big issue and the client says, hey, we know there's a big issue, just give us 50% of the money back, or just give us the money back that we've done, and we'll go from there. And you've spent it, or you've spent 80% of the cash, you're going to have to go find that money, right? And that's not a good situation that you want to put yourself in, you or your family or anybody that you happen to be working with, your employees, whatever it might be. And then debt pay down. As you get bigger, as you decide what clients you want to work with, as you figure out, depending on your consulting, different freelance work and different consulting work to this end can require different teams, different investment, different capital needs. So to a certain degree, you may have some debt payments, or your clients may have debt payments, and they might have to factor those debt payments into how they're paying you. So understanding, what does debt pay down look like? What does the flow of capital look like for the clients you're working with and for your business? Now, for our purposes, the stuff we want to focus on: projection model, budget, and cash flow, right? We want to know where we want to go, we want to know how we want to get there, and we want to know what we can afford to spend. So we're going to focus in particular today on the projection model, because the other two are basically taking the projection model and tweaking it and really kind of seeing it for what it is, right? And seeing it for how you can use it, not necessarily making 100 changes. So typical use cases. So use cases for business models and for projections are really varied, but the three most common are business validation, right? A lot of people, freelancers aren't just 22-year-old kids out there trying to do graphic arts, right? Which by all means, if you're talented, go for it. But they're senior individuals that are, ex-corporate, and they want to do consulting, or they want to freelance and they want to, make some money, or use their skills, or they're bored, whatever it might be. But understanding, like, hey, is this really worth my time? Like, I'm an ex-CEO of a $35 million a year business. Do I think that I really want to freelance? Do I think that I want to do this? Like, what are your options? Or you're a 27-year-old who's got some skills in IT and wants to freelance within a specific sector. Great. How much do you need to make? How much do you need to validate within your business in order to justify doing the work that you want to do? Investor pitching. So this is, investor is the bank, investors your friend, investors if you're raising money, whoever you could be talking to potentially require some money or ask them for money, resources, help. It's all the more powerful if you can show them that you have a plan for it, right? Whether it's a plan for a favor, or a plan for capital, or a plan for short-term financing, whatever it might be, to show that you actually understand the financial implications of business decisions, which it's the number one critique that we see of businesses that we work with from investors is, do you understand the numbers? Because numbers are not supposed to be scary if they're done well. They're supposed to be informative. They're supposed to allow you, the CEO, the freelancer, the small business owner, the startup co-founder, right? They're supposed to allow you to make good decisions based off of your goals, not just be something that exists in the background that doesn't do anything. You want to have informed value, right? This is where business planning comes in. Great. Your business logically works. It's rock solid for investors, but what's your plan? Do you want to be a freelancer forever? Do you want to be a solopreneur as a freelancer forever? Do you want to have a small team? And how are you going to get there? And what are the costs therein? Core tabs. So this is really an exercise in kind of keeping it simple, stupid, right? Where it's you want to have a cover page because everybody loves professionalism. You want to have a set of assumptions. You want to have one page where you're driving a vast majority, if not all of your assumptions from. So that way it's, hey, what if our conversion rate of every 100 clients we talk to isn't 5%, it's actually 7%. You want to be able to change that and then watch everything flow through and go, hey, now, if I actually achieve that, I can afford to spend an extra $3,000 a month over the next 3 quarters in marketing. That's a win for me. Those are the types of decisions and implications and adjustments that a well-built model and a well-built, assumption part of the model can really provide you. You have your projection output, which is, of course, your revenues, your expenses, seeing where does the game end. Your revenue and expense build, which are, how am I making money? How am I spending, or how am I spending the money I'm making, right? And then any and all supporting data. It's great when you have a rough idea of things, but if you can quantify it, if you can find industry work on it, if you can validate it in some way, it's all the better, because it just makes your life infinitely easier, especially depending on the party that you're answering to. So for best practices, the kind of big rules that I have in my head are simple as possible and complex as necessary, meaning dumb it down, but don't make it dumb. Probably the best way of saying it. So you want to make sure it's digestible, easily understood, that someone can read it. And you'll see what I mean by this when I show you the model that we're going to flip through. You want to show that you have defendable assumptions, right? Nobody wants to meet the freelancer that speaks to their margins, you know what I mean? And when you're talking about how much you actually are going to make or how much you're going to grow, they throw out some ridiculous number that even from a visual perspective, you go, is that reasonable? Does that give comfort that this person knows what they're doing or has their goals in mind or has reasonable expectations? And if they think this for their business, how are they going to properly inform, my business, right? It's a question of, are you really showing the strategic side of your work? And again, you don't have to be sitting up here with over a chessboard like a general leading yourself to victory. You just have to be somebody that took a second and said, what are the impacts of the decision that I'm making right now? And am I informed about them enough to feel like I'm making a good one? If you ask that question and those types of questions regularly enough, all of a sudden you have a business and a decision-making process and a financial model and financial decisions that are rock solid because you've questioned them and you've pushed on them a little bit, even if you didn't beat them over the head with a hammer like, someone like me would do to make sure it's really, really strong. At least you've started to test and at least, separate the weak, right? And last but not least is industry and hiring norms. You got to know what's going on in your industry. You got to know what's going on, the latest and greatest, whether it's regulation, sales, big companies, competitors, top players, like know who's around, know who's hiring who, knows who's doing what, because that's all informational. That's all information that you can use to improve your business, your actions, your client acquisition, whatever it might be. Key metrics. So I use this because there's really no perfect key metric, right? The key metric, I think, is the best way for you to determine success of your business. And the example I'll use is Uber, right? Because everybody understands that. When Uber was looking at kind of their North Star metric, the one metric, if we have to bet on one thing, what are we going to bet on? They picked not rides requested, not drivers, not average drive time, not average ticket value. They did rides booked. Because that makes sense. You're a marketplace. You have two sides. So if our goal is to match, why don't I make the thing that I'm really betting on the most matches possible? Because the most matches means the most returns, the most cash flow, the most success, the most driver demand. It captures everything in one elegant number. Now, what is that number? Or 2, 3, 4, 5? Really, you kind of should only have 2 or 3 because then it starts to go, do you really understand, what your core metrics are? But you should look at these and say, what are my core metrics that I can use to hold myself accountable that actually mean something for me, my business, and my goals, right? Uber was looking to scale and become a multi-billion-dollar startup. So counting on the wins is really important. Your win might be the hours or the revenue made versus hours used. Like, hey, I want to be doing work where I can charge $300 an hour, not work that charges me $100 an hour. So maybe I should track my time versus my investment and what this actually implies. And then all of a sudden, hey, I've got a North Star metric. My business is getting better. My actions are getting more planned. I love it, right? Revenue streams, cost of sales, understanding your variable and fixed costs. These are the implications, right? Your business is a financial business, whether you want it to be or not. So understanding what your goals are and how your expenses, especially the relationship of variable to fixed, in terms of what that means as you service more and more clients or different tiers of clients. Big questions, big answers, and they really require a lot of thought. So that way you can understand, okay, if I'm servicing these 10 clients, yeah, the revenue's 8 times what it normally is, but the expenses are 10 times. So I can actually only afford to service 4 big. The rest I'm going to have to go small because while I'm making less money, they're also less expensive to service. So I can afford that. Again, strategic decision making. Business model. So when you're looking at a business model, right, a revenue stream is any company's source of revenue, right? It's we're getting money from providing this service, then we're providing this other service, we're getting money from that service. So it could be ad-based, it could be transactional, it could be usage, like if somebody's pulling oil from the ground, right, like at a gas station. It could be direct sales, if it's just selling widgets and different items. It all is dependent on kind of what you offer, but it's important to understand how you make money, right? We're a software business, we charge monthly. I'm a freelancer that does writing, I charge hourly. I'm a freelancer that does business plan creating, I charge per business plan based off of page count or whatever it might be. Questions you just need to understand: one, what is my core way of pricing? What's my core revenue streams? And then two, what are my future? And if that means it could be bigger, it could be better, it could be different, it could be having 7 revenue streams, it doesn't really matter. It's a question of, what do you want for your business? Now, when we look at pricing is one of those very individual type questions, but I'll tell you the theory and then you can put it into practice. So the theory of pricing is you're never going to get pricing right. You're only going to get pricing more efficient, which means Apple doesn't know to charge you $1,000. Apple knows that in their market testing, if they charge you $11.50 or if they charge you $8.50, the people that buy and sell, when they look at those numbers, they're going to make the most money at $1,000. They have tested it. They have structured it. They've done the research to say, I don't really care what it is, because as long as I sell it for over $50, yay, I'm making margin, right? So Apple's fine beyond that. So the rest of it is demand, which is when are consumers going to want it the most so that I can maximize my revenue? Now, as you look towards you have to think about maximizing your hours spent, right? There's only so many hours in the day. So prioritizing people that are going to pay you a higher hourly rate or pay you for higher ticket projects, it's reasonable, because at the end of the day, you're going to end up spending more time and therefore, maximize your return. And we'll talk more about that. Perfect. So now I'm going to switch over to an actual financial model, and I'll give you guys a run through of that as well. And that'll probably take like 20 or so minutes, and then I'll answer any questions and happy to call it from there. So let me hit share. And I can't go full screen, but I'll just do lots of zooming. So let me know once this is up and ready. Perfect. Miss O'Neill, just to make sure I'm good to go. This is my screen share is going right now in the Excel, just to make sure. Perfect. So on this, let's just kind of kick off. So similar, as I said, a nice simple cover page, right? Something that looks nice. You could have a logo here. You could have whatever you want. But when an investor, when yourself, when your company, when your teammates open this, you go, hey, this is good stuff. This actually is a financial model that was built by somebody that understands, a little bit about formatting and a little bit about structure. And I'm going to read this line down here because I know it's hard to see, but this was carefully constructed because it kind of speaks to what the goal is here. The purpose of this model is to give an overview of the potential revenue, expenses, and overall return that Writing Inc. can provide in the first 3 years of operation. This model is not intended to be a measure of financial return, but instead an indicator of a sustainable business model, right? Assumptions were built on extensive market research and conservative projections. That right there is kind of, the inscription to the book of financial model building, which is we can't read the future, or we can't predict the future. We can't plan for every expense. We can't plan for every revenue, which is great because we want to be surprised and grow and scale and do all these wonderful things, right? But what we can do is make sure we're thoughtful, make sure we've counted on our revenues that we intend to get, make sure we understand our expenses and how those expenses, correlate to the revenues that we're aiming for. Make sure that our assumptions are thoughtful. They're not arbitrary. There's no random assumptions in here that don't make any sense for what we're trying to do. And that we're trying to show that this isn't we're going to make $800 million, but hey, this business works. This business functions. And if I do well, and if I set the right goals, bam, I can win. I can grow, I can succeed, right? So let's start with the end because it's kind of easier to go that route. So this is the end result, right? This is your business. This is an income statement, a projected income statement. I'll zoom in to make it clear. This is 3 years of business. This assumes that we're a writing company that also does referrals. So as an example, I'm a freelance writer. I charge $100 an hour, and I have other freelancers that I work with, whether they're other competing writers that do different industries or different focuses or whatever it might be. But I also refer them revenue, and therefore I get a commission from it because we have a good partnership, and we'll talk more about that. But just so you understand conceptually, so here I'm doing $1 million, $8 million, whatever it is, of value, of client value for my customer. How much am I actually making? Well, you'll see here, for every $1 million of value we provide, we're actually charging 10%. So we're making 100 grand, we're making 350 grand, we're making 900 grand based off of the 1, 4, 3.5, and $9 million. Our net referral revenue is saying, hey, look, in year one, we made an extra $8,500 because we referred people. That doesn't seem like much until you get to year 3 and you realize that you just made another full-time job doing nothing. You just made $85,000 because you were thoughtful in this year and you were strategic and you built this year to this year. You went from 8 to 26,000 and you kept making referrals and you kept forming the right relationships, and all of a sudden it grew into an income of its own. These are the things that happen when you plan, because this money doesn't fall from the sky. These relationships don't fall from the sky. These partnerships, these trusts, these return, them delivering value that you want to do. Also, clients take a while to service. You could give somebody a contract that takes 6 months. You're not going to see that money until 6 months from now if they want to give you a referral fee and if you agree to that. But if you think and if you plan and if you play not the 50-year game or the 100-year game, you play the 3-year game. You play the 5-year game. You look to the 100-year game and where you want it to end, but you at least plan for these games that you're playing in the meantime, because there's real options, real growth. Like, this is a new house, this is new investment, this is an employee, this is whatever you want it to be. Cost of sales. Now, again, we're assuming this is a writing company. So cost of sales is basically, let's say I'm the CEO and I'm the leader of the organization, but I'm also the best writer we have, right? Let's just say I'm a CEO of this business and I want to grow this business over time. I want to have some employees, some more people that do writing for me. So I still function freelance and more as an ad hoc writer for different companies, but I'm growing, I'm scaling, I'm, doing what I can. So cost of sales in this scenario would be me, the CEO, or anybody that's also doing the operating work. So I'm a writing company. So any hour I spend writing and not managing, that goes here, because that's a cost of sale. That is a cost of me providing the value to actually service the customer. If this were a hard good company and we sold trucks, it would be the cost of the trucks, the labor, the materials, whatever it is that I actually make. So I sold the truck for $10, the materials and cost of labor and everything. The cost of the good that was sold was $7. So gross profit would be 30%. I made $3. Now, after that, you fall into general expenses, which are, okay, yeah, you made your money. Yeah, you had a cost of service, meaning the value that you actually had to put in to actually provide earn the revenue. But now you have operating expenses, right? Which are your sales and marketing expense, the stuff that you're spending on Facebook and Instagram and LinkedIn and whatever else it might be. You have your sales and marketing staff, your sales and marketing manager, right? Or the person creating your social media posts or the person being your CMO. It's very different than that person just spending 5K of money per ad per month. Those are different numbers because one is the manager and one is the actual expense, right? General administrative salary. So in this scenario, I'm the CEO, right? Well, I'm the CEO half the time, but half the time I'm also a writer. So in this scenario, you'll see the way that we did it, for simplicity's sake, is let's assume half the time I'm doing CEO duties, half the time I'm not doing CEO duties. So my CEO duties, the stuff that's not for specifically providing value based off of a revenue, a service, or a product, right? That goes in here. Because that's time, that's expense, that's general, it's operational. It's not for the specific purpose of delivering on the value to get the revenue, right? When in doubt, focus on the revenue. And then general and other expenses. Businesses got a lot of random stuff. There's random people, there's random expenses, you need paperwork, you need travel stuff, you need whatever it might be. So you have to project those because those come up in one way or another. You have your total expenses, which obviously shows, the total general expenses that you have along with any cost of sales that you have. You have your profit and loss. So in this scenario, what this says is you have made 114,000. You have spent 305,000. So your total profit and loss before any taxes, before anything else, is you've lost 200 grand. So if you were a startup, we would say you need at least 200 grand, to meet this need, because this is what your net is over the course of the year. Now, if I was a smart startup advisor, what I would say is, yeah, but all this money doesn't come in at once. So it doesn't really matter how much I lose. It matters how much I want to spend, because I want to spend this 305,000. What if 255,000 of it are spent in the first 9 months? What if I have to spend it then? So that way I make 30%, 40% of my revenue in the last 3 months of the year because of the expenditures I did in the beginning of the year. All of a sudden, just because you have most of your expenses in one part and most of your revenues in another, if you don't have that 305,000, you're running out of money the whole way down potentially. And that's not, as a business owner, it's not where you want to be, of course. As you move forward, you'll see in year 2, hey, look, we made a net 380,000. Yeah, but we're still spending 385,000. So net, we ended up actually losing 100 grand, right? Not exactly what we want, but again, closer. Year 3, we've moved to the positive. We moved to the black. We're making money. Great. So these numbers are variable. These can be in months. These can be in years. And the nice thing that I like about the way that we do our models is, see, this number's a negative. Well, I know it's a negative because expenses are greater than revenue. So I can just go all the way to the right. And as soon as it flips to positive, I know, hey, look, this is the first month that I made money. So month 11 of year 2 was the first month that I walked out and I made more that month than I spent that month. And that's a great thing because now I know where my goal is. I know where my break even is. I have understanding of decision making, of decisions that I can make that will change this date, whether it's more expense, less expense, more revenue, less revenue, quicker delivery of service, shorter delivery of service, whatever it might be. So this is, again, where we end up. Where we end up is based off of certain assumptions. So in this scenario, we kind of have a few different layers to the assumptions. One is our leads, which is how we're actually getting all the people that we hope to close. 2 is our client conversion. We have our client detail because, of course, not everybody is a small client. Not everybody's a large client. We have a variety of clients. The way that I would think about it for you is you have to understand your buckets. You have to understand who your target is. If you're only servicing one type of client and you only have, we do 1 month of service, or we have a 3-month contract for $1,000 a month. We never go higher, never go lower. We just keep selling that one thing 100 times over. Great. It's a one-time thing. The only thing you care about is how often somebody's purchasing it and how long they're on that 3-month thing if they don't cancel in the first month or 2, whatever. But if you're the average business, which has rich clients, poor clients, big clients, small clients, whatever it might be, this is how sophisticated multi-billion-dollar multinational companies think. They think in terms of averages because they know that the accountants are where the details are for. Meaning, yes, we're going to get our specific spend and our specific profitability and our specific taxes. And yes, we want to do all that. Yes, we want it done legally. But is that what drives our decision? Because knowing that it's 38.67% margin versus me seeing that it's roughly 40 doesn't change anything when it comes to my ability to make decisions on that. So to that end, when you look at your small, large, and medium clients, or your enterprise, small business, and freelancer clients, or whatever it might be, you have to see, what are my expectations? What are their purchasing? What's their purchasing power? You know what I mean? What's their purchasing timeline? Because all of those have implications into how many leads you get, how long it takes to close. Because the very simple, easy example that I'll use here is, imagine you're selling a piece of enterprise technology, something that a whole multi-billion-dollar company could rely on. That's expensive. That involves a certain level of access. That's a certain ticket value, but it also requires a certain timeline for you to sell it, right? People don't make those decisions every Wednesday. That happens once a year, twice a year, big board meetings, lots of budget conversations. Like, it's a big deal. The payoff is huge, of course. Yay, you win. But that doesn't mean that the expense for trying to get that payoff isn't also huge or very long. Contrast that versus McDonald's. You walk in, you make money, boom, it's over, right? Very different expectations. And that kind of methodology, that thought needs to play out when you're looking at the financial model here, so that way you can build that in appropriately. So in this scenario, we're saying our large clients spend $5K a month. Our small clients are $1,200 a month. Our large clients are actually with us for 4 months. Our small clients are with us for 12 months. So our large clients are worth 20K and our small clients are worth 14K, right? And again, these are mock numbers, so that large client could be 100,000, right? It's all arbitrary. This is one revenue stream, right? This is one way of me making money. The same story, very simplified, plays out here because I have referral revenue, right, in this scenario. So I actually start by referring 20 hours a week to somebody. So this is somebody that I work with, somebody that does a complementary business. You know, I'm a finance person, they're an accounting person, I'm a business plan writer, they're a pitch deck maker, you know, whatever it might be. You're consistently working with this person. You start referring them 20 hours a month. And then let's assume that whether it's working more with them or working more with others or growing your business, you're actually increasing how much you're referring. You're actually increasing how many clients you get across all streams slowly and steadily over time. Because again, that would be the base assumption for your business. Just a question of how much or how little or how steady or how fragmented, right? And then you are getting 20%. So let's assume that your friend charges $200 or does 20 hours of work. It's $100 an hour. So you know that's $2,000. You're getting 20%. Yeah, you got $400, right? Everybody wins. You have tax rate. You can have web development depending on how much you're actually doing. And these are more other assumptions depending on what you've got going on. So revenue. So quickly to kind of look through this, this is what I mean by read the model. And I'm going to read this model to you. We begin with a total marketing budget of $5,000 per month. The average lead cost is $100 per month, which on a monthly basis, we expect to yield 50 leads. We also expect to make a number of phone calls throughout the course of the first month, which will yield 10 additional leads via cold outreach. Of the people that we actually connect with and of the clients that we've had in the past, we imagine that at least 10% of our leads can be expected to refer other people. So we have a total of 60 leads here. 10% of that would be 6. So let's assume our total leads is 50 plus 10 plus 6. So we have a total lead of 66. Now, from a conservative basis, based off of what we've seen, what we know in the marketplace, we see that 10% conversion is more than reasonable. So in the first month, we have 7 clients total. That was me reading that lead build, right? That is how an investor should be able to see this, and how when they hit F2 and look at how the formula is built, none of this is overwhelming. Yes, there might be things or questions, or how do you format like that, or how do you get these weird blue boxes around that like make it look all fancy? It's like, yeah, but that's all just, you know, bits and glamour, right? Which I can teach you and I can show you, and it's all easy and fine. This is the mechanic of it. This is where the value is, because it's, I've got this many clients now because I've thought through everything. I know that these clients pay $5,000 a month, they pay $2,000 a month, they pay $1,200 a month. I know of those 7 clients, 10% of them are going to be large on average. 60% are going to be small. But because I've been thoughtful in my assumptions, I'm saying that, hey, the large clients, yeah, they're 10% in the beginning, but halfway through the year, they're at 15%. And then my small clients, yeah, they're at 60%, but by the time we get to year 3, they're at 40% because I'm getting more mid and large size clients. So that 7 that's here is more, it has more weight down here because all of a sudden it's more big ticket clients, which have a bigger impact. Your revenue build tells the same story. So how do we take these numbers? How do we take these leads? Figure out what the commission is. Understand what the value is that we're going to be awarded every month and what that actually means on a commission basis. So yeah, we charge $5,000 and we're going to actually make 10% of it, whatever it might be. We're, of course, merging everything together. So you can see in this scenario, look, we did $13,800 worth of value. We charged a 10% commission. So we made $1,380, and that was our month's revenue. In addition, similar to we talked about, look, we made an extra $400 because we referred somebody. Again, this looks like nothing now, and it is nothing now. But you pay attention and you follow it through, and it's 85 grand later. So again, little decisions, big impacts later. Here you get to see, okay, yeah, this net referral revenue doesn't seem like much, but hey, it's growing. And hey, it really is growing. An extra $3K a month, that's not bad. That's a free office, and a big one at that, depending on where I am in the country. So good questions, good decisions, good understanding of what these, you know, what this revenue can mean. The same flows through to the expenses. I've brought all the expenses onto one page just to make life a little bit easier for explaining this, but your taxes, your Social Security, understanding if you're going to have to pay anybody, depending on if they're an independent contractor, if they're an employee of yours, depending on how you're functioning. Again, freelancers have the pick of the world, so you can structure how you want. So in this example, we're seeing that I have a staff plan. I have project managers, I have operations people that are doing work with me. I have a CMO that's helping me actually do marketing efforts. I have sales people that are helping me, whatever the components are of what your business is, not only today, but over the next 3 years. Because in this example, you'll see, hey, look, the CEO, this is half my salary. That's half of the 7,300 right here. Oh, look, the CEO is allocating half his salary towards CEO duties, and half his salaries as an operator down here. That's what I was referring to earlier. This is a sophisticated view of what your time means, where your time's going, and how you can differentiate. You go down here and you see, oh, look, it looks like the operations person, looks like they're going to hire another operations person 6 months in. Okay, I see that. That's interesting. So it looks like the CEO is going to be doing the brunt of it, and then he expects there to be enough work at this point for there to justify an operations person. Okay, that's a story that this model is telling me now based off of what I'm reading. And it flows through. It has the same implications for the salespeople. Look, this salesperson, NA, 0. Why is that? Oh, it looks like the first salesperson they're working with, they're only going to pay commission. So there is no expense. It's just they make a little less revenue. So instead of making $10, they make $8. So that is a sophisticated level that maybe somebody wants to build into this model if they've determined it's effective or not, or if they've determined it's not effective. Salesperson 2, maybe they're a salaried person. So they come in, again, from the very beginning. They're taking all these monthly expenses and, oh, look, things are growing over time, right? So what this does is it allows you to look at it and say, okay, I've got general staff. I've got people that are in my general administrative, people that are doing broad work. I've got people that are doing my sales and marketing work, people that are actually going out and generating interest. On my operating expenses, which are, the day-to-day expenses of running my business, I have office rent, I have cost of sales, I have general expenses, legal, all these things that need to be accounted for, need to be planned, and need to be seen because, yeah, in month 1, you're only spending 12 grand a month, which only, you know what I mean? But by the end of the year, you're spending 20 grand a month. Do you actually understand where that money's going? What's happening, why it's growing, what the drivers are of value? Because this marketing expense is an expense, but if I go to where it is, it's also an asset because the more I spend in marketing, the more leads I get, the more clients I close, the more revenue I make. So finding that balancing line and going, I see, I can afford to take the risk of $3,500 of expense a month because that's way easier. And to do that, I just hit this $3,500. Everything has flown through. It's still growing at 10%. It's still flowing through. Every number, every output has changed. Oh, look, we're making good money, but less money, right? Because we're starting from a lower base to grow off of. Those are big impacts. So a big thing to realize here for your cost of sales is, again, because you're the provider traditionally, especially if you're working more as on a per hourly basis or per project basis, your hours, your time, that is the cost of sale. That's what's necessary to provide your service. So in that way, you find yourself in a really solid position to show that you understand your full business model and where your expenses get allocated. Valuation, this is more relevant for startups, but I actually think it's helpful for startups and small businesses. But I think it's helpful because, again, like we talked about on the output page of you're not losing 190,000. You're spending 280,000. That is a difference in mentality, right? So in that way, when you go to valuation, look, we're spending 280,000. This is what it's all pulling from. Over the next 12 months, this is what we're spending. Okay, let's build in some hedges because I don't know about you, but I've been wrong before. I've been wrong about a lot of things, especially when it comes to random people and hiring and sales numbers that how am I supposed to know? You haven't proven it out. How could I know that? Right? So I assume, okay, let's assume that these numbers need to be bigger, that they need to all be bigger than they are. Okay, so our sales and marketing is 137, now it's 145. Our development is now 70,000. Our personnel is now 50,000. Our operations are now 25,000. Our legal's 15, and you can see the chart updated automatically. What this says is now, if I needed financing, if I needed to go somewhere to find money to help service this business, what I would do is say, okay, look, it looks like I'm actually going to spend 281, but conservatively, it looks like I should at least have capital for 305. And I can see how it's allocated here. Oh, look, I'm putting a lot in sales and marketing, a little bit in my development, a little bit in my personnel, whatever the allocation, of the day might be. But these are questions, and these are, oh, I know how I'm spending my money. Now I know if I have to go to mom and dad, if I have to go to my old boss, my grandma, my rich uncle, number 5, whatever it might be, and ask for money to justify me launching my business or making these expenses or doing these things, look at this, I have a story to tell. Look at this, I have information to share. Like, that is where you want to get to. And to give you just one last little point to kind of give you an example of what it means to be thoughtful. So when I say be thoughtful, what I mean is we have a $5,000 a month client that's here for 4 months at a time. How are you counting that revenue? right? In your head, think about that, because that revenue, that means it's there for 4 months, then it falls off. So you have to make sure you count for that. So this scenario, this is an example of where you can interject certain levels of complexity for good storytelling. So the high level of this is, this says 4 months of spend, $5,000 a month. So if you join us in month 1, look, if you join us in month 1, this is a counter. So 1, 2, 3, 4 in month 6. If you join us in month 2, month 6 would be at month 7, etc. So you can see, and again, I won't go through all the formulas, but look, we are counting per each one this $5,000 4 times. And then when we get another one of the $5,000, we count that 4 times. We count that 4 times. So our revenue per month isn't just 5,000, 10,000, 15,000 as we add client after client, but you'll see that our revenue actually stops. We lose $5,000 at this point. That needs to be reflected. So you see this 20,000 doesn't change. It goes from 20 to 20. That's sophistication. That is understanding life cycle and revenue management. So that way, when you look at your revenue build and you look at what you can reasonably project in this outcome, you're not assuming that you're making oodles and millions of dollars unfairly. You're actually thinking through, oh, I have cash flows. Oh, I have impacts. And when you look at this model, and again, there's so much content here. There's 100 presentations I could give on this stuff. So I wanted to give you a big, healthy snapshot. Nothing scary, but something that shows you that this is digestible. I have an uncle who's a professional tutor, and he has a great phrase stuck with me ever since I was a kid, which is, how do you eat an elephant? One bite at a time. And that's what this model is, just one big elephant. So take it piece by piece, focus on the different areas, understand your revenues, understand your expenses, understand your plan, your vision, and feel free to reach out. I'm here to answer questions. I'm here to provide value and do what I can. I'll screen share my other presentation, which has my my QR code, so that way you guys can always add me on LinkedIn or reach out, or do whatever makes the most sense. Happy to be helpful where I can. And I'm happy to answer any questions. If anybody has anything, feel free.
Thank you, Aaron. That was great. We're gonna wait a few minutes, see if we have some comments, because it takes a bit to show in the screen.
Oh yeah, all good. No worries at all. Hopefully that was helpful. Let me know if there's anything that you think I should go over a bit more. I know we've got a good chunk of time. I'm not sure how long this ends up actually going for, but happy to answer any questions until we run out.
That was great. A lot of information, a lot of great stuff.
I tend to talk a lot, and for me, it's I don't know, and I'm sure people that are sitting here viewing it, hopefully they saw it, because I can't stand when you go on presentations and they just pitch to you for half the time, and it's like, yeah, I came here to learn something, like teach me something, please. So for me, it's like, if you want to work with us, great, by all means. But if you don't, just learn something and then go make your business better, and get out there and win. That's what it's all about.
Yes. How can we get the template for
yeah, the template? Feel free to reach out. I can definitely send that to anybody that's interested, and we can go from there. So yeah, I've got my QR code, I've got my email, so you can reach out, you can add me on LinkedIn, you can do whatever you like, and I'm happy to help. And I can always get on a call and do a little screen share and answer any quick questions. So happy to organize time and do what I can.
Perfect. We don't have any questions or comments.
Sounds good. That's totally fine. So feel free to reach out. Everybody knows how to reach me. I'm glad I could be here. Hopefully you learned something. Hopefully, this was more valuable than the average session, and you really kind of got to walk away with something practical that'll help you going forward. So feel free to reach out. I'm available. I'm here, and thanks for the invite. Happy to present.
Thank you.
Thank you very much. Appreciate it.